Hello and welcome to Tax News with Glen Birnbaum. Glenn, hey, we were talking before we got started here, and you wanted to talk about the cash basis versus accrual basis. So, give a little background on that and why one's more important or one is more beneficial than another.
Yeah, Casey, we thought we'd just follow up on our last week's discussion about, that we think lenders are going to require more of an accrual basis financial statement, possibly that a CPA has looked at or a review versus an audit, some of those things, that lenders are going to require this. And I talked a little bit about, the difference between accrual basis income or what we call book income and then cash basis income and what we call taxable income. So we thought we'd get more specific on, hey, what's the type of adjustments that you would make to take your books from cash basis, which the vast majority of our farm clients that we have, are cash basis, to take them from cash basis to accrual basis. So that's where our discussion is going to be at today.
Sounds good.
All right. So I guess first thing, there is this organization called the Farm Financial Standards Council, and so you can Google that, check out that website. They do provide quite a bit of information about how farmers really should try to keep their books, because accounting for farming is a little unique. It is kind of manufacturing, but it's really not manufacturing from an accounting perspective. So encourage you to check that out. Again, it's the Farm Financial Standards Council. It has a lot more specifics, but I just thought I'd kind of hit some highlights today. So if we're talking about accrual basis, book income is what we call it. There's several things that we would have to adjust for. One of them would be book depreciation. Okay, so for tax purposes, we can probably write off equipment very fast, possibly all in the first year, right, or over a very short period of time. Well, for book purposes, you really would not want to do that, right? Because you would try to estimate. This is one of the tougher things. Well, there's some judgment calls here. This is one of the bigger judgment calls. Is how long of a life should I use for this piece of equipment? And I might encourage them to talk to somebody like you, right? And you have a pretty good sense, about what is actual economic depreciation, right, on a tractor, on a combine, actual economic depreciation. And sometimes you may have to factor in salvage value, right? For tax purposes, you just write this thing off over, even if it's over 5 or 7 years, not in the first year, but you write it off to zero, right, down to zero. Well, generally speaking, right, a tractor or combine is going to have still some value after 5 years, after 7 years, whatever it might be. So definitely you have to make some judgment calls on that, but you generally are going to use maybe more of a straight line life, and again, maybe have a salvage value, but it's not going to be near as fast a depreciation as it is going to be on your tax return, right? It's more of a gradual economic depreciation. So that's one of the bigger judgment calls you'd have to do. You'd have to almost go back and kind of recreate your book depreciation schedule. But once you do it once, it's not that hard to keep up with, but that first time you do it right is tough.
Right.
But once you do it, and then you'd have, my policy is going to be, it's going to be X number of years for combines or X number of years for tractors, right? You'd kind of set an accounting policy. So that requires some work. That's one of the bigger judgment calls. Now, other things look quite a bit easier, right? If I'm paying for fertilizer for next year or chemicals for next year, I'm not going to immediately expense that, right? Because that's for next year's crops. So that's going to be a prepaid crop expense. So that's going to be actually an asset on our books. We're not going to just expense that. We're going to treat that as an asset. So, that's pretty easy to do, right? You just kind of have to go through and accumulate what expenses are for, 2019, what are for 2018, and just kind of match it off of that. Same thing with cash rent, right? If I'm paying for next year's cash rent or if I'm not paying, if I've got accrued cash rent, right? So at the end of the year, I haven't paid my full rent for 2018. For book purposes, you'd have to book that as a liability, right? You couldn't just say, well, yeah, I only paid, half my rent. You got to match it up, right? So prepaid expenses, crop expenses, prepaid rent or accrued rent, those are pretty easy to do. I mean, at least you know the number. It takes a little effort to maybe have to do a schedule of all the land you farm, but, pretty easy. Just matching principle is the key thing. Now, one of the bigger adjustments that you make, and this is different than a manufacturer, is you've grown the grain, right? It's in a bin or it's at the elevator, whatever it might be, but you haven't sold it, right? And so normal accounting would say, well, don't recognize revenue until you've actually, lined up a customer, right? If I'm making widgets, I can't sell, mark my cost up to market because I don't actually have a customer. I haven't delivered the product, right? So that's basic accounting 101 there. But for farming, there's a special rule that says, hey, if you're growing a commodity, i.e. like, corn or beans, whatever it might be, wheat, and you've harvested it, right, and it's in your bin or it's at the elevator, you can use a market price for that commodity. This is very unusual for accounting. Accountants don't like this, I'll be honest. It's just different, but it's very simple. I mean, farm accounting makes sense. So the only thing you have to make sure you do is, if it costs you 10 cents to truck it to the elevator, or, right, you got to factor in that trucking cost. But you actually are going to use the market value of your crop, even if you haven't sold it, right? So revenue under this book accounting is your yield, right? The number of bushels you produce times a market price if you haven't sold any of it. So it's accountants don't like this normal accounting, right? Because if I haven't sold anything, I don't have revenue normally, right? But for farm accounting, if you've produced it and there's an established price, you market to market, okay? Now, obviously, if you've priced some of those bushels, but maybe it's for January delivery or something, then you would use the market price for the bushels you've priced. But the unpriced bushels, you use just whatever that bid price is on 12/31, let's say, if you're doing accounting. So the thing to keep in mind there is it's unrealized, right? So, either good or bad, right? It can hurt you. Now, last year, cash prices were, as I recall in our area, they were pretty low on December 31st. They might have been like 320 or something, just say, right? So if we've got a farmer we're doing books for this true accrual basis accounting, we'd use 320 on any bushels that they had priced. Now, if in the next year, that was at 12/31/17. If next year in 2018 they sold those bushels for 360, let's say, right? Because the market did rally, there could have been more than that. Let's just say 360. Then that 40 cents difference, right, 360 versus 320, would actually show up as profit or revenue in 2018. Okay.
Even if you didn't sell it?
Even if you didn't, well, and if you sold it.
Yeah, okay.
Yeah, if you sold it in 2018 at 360.
Okay.
Right.
All right.
But last year we used 320, then you're not going to record the full 360 again. It's just going to be that 40 cents difference is going to be revenue. So, but it can go the other way, right? If it was 320 and then I sold it for 290, right? That's a 30-cent hit. So it's economic, but it's still very much subject to the market whims, right? So it almost penalizes you. It says, hey, act like you sold it for the market price. If it goes up, if it goes down, there's going to be a reminder that, hey, darn it, I should have sold it for 320, right? Because it's 290 now, or vice versa. So, and usually we try to maybe just identify that difference, that 40 cents, just to kind of know that, okay, well, part of this is somewhat just because, we acted like we sold it at 320 before. So that's the biggest takeaway. But in simple terms, it's just your yield times your price, right? That's your revenue for the year. If you produce these bushels in the calendar 2017, 2018, whatever year we're talking about, that's your, obviously, bushels, and you just got to take it times the price. If you sold it, if you've actually priced it, you use that price. If you haven't sold it, you use the market price at the date of the financial statements. So there's not much judgment involved, right? It's pretty clear what price you're going to use. You can look at different terminals, different elevators, right, and pick the best price. But there's not near as much judgment as like that book depreciation we were talking about. So the same thing is true if you've got grain contracts for next year. This gets a little more complicated, but if you've got a contract for 2019 or 2020, right, and you haven't produced any crop, then you really should mark that contract to market as well, right? So if I enter into that contract on May 31st and the price was 360, and now at December 31st the price is 350, right? You'd have a mark to market on just a pure grain contract as well, if it doesn't relate to the crop year we're talking about. So same, we would be very much the same as your futures contract, right? If you got a board of trade account, the board of trade account marks the thing to market every day, right?
Right.
You have margin calls, so it's very easy to get those prices. So it's really it's a market value for your grain and a market value for any sort of grain contracts. So lenders kind of like to see that because, hey, it's actual market value, right? So the good thing is, Casey, you don't have to worry about what your costs are. You know what I'm saying? At some point you do, but then once you've grown it, the accounting says, well, we're going to just market to market. So it's kind of weird. You kind of throw costs out the window. I mean, your costs are still your expenses, but you don't actually cost it. Whereas most manufacturers, if they're making farm equipment, they're going to, hey, what are my costs to make this combine?
Right.
And if it costs them $200,000 to make this combine, but they can sell it for $350,000, just kind of using some rough numbers, right? They don't get to mark the combine to market for $350,000 just because they built the combine. They've got to actually have a buyer and have delivered the combine. So it's different. So that, again, a lot, even accountants that are very used to accounting and accrual basis can struggle with farm accounting because of that mark to market aspect.
All right. So what happens if I'm? How do you do that? Mark. Okay. So you cut your grain, you put it in the bin.
Yep.
You market to market, and then, but at the same time, you also sell 25% of your wheat right after you cut it. How does that affect the overall outcome of what you do?
So if you've sold it, so you're talking about there's wheat in the bin, right?
Right.
You got 100,000 bushels of wheat in the bin, let's say.
Yeah.
And if you sold 25,000 bushels at say $5, then that's the price you'd use on those 25,000 bushels is $5.
Right.
Again, in theory, you should have transportation too, right? If it costs you a little bit to get it there. But then the other 75,000 bushels, you just use whatever the bid price is at 12/31, let's say, if that's your financial statement date.
So if I sold a Ford contract for $5, but the board price is whatever, $4.85 or whatever, and there's no profit or anything that comes into that. Like there's no the difference between the $5 and the 15 cents a bushel. There's no.
That would be in your. Ultimately, your profitability is what you're going to sell it for, less your cost, right? So we know what your costs are. We got to watch that with prepaid expenses and accrued rent. But my cost, and so if I sold it for $5, that's going to be more profit than just using the market price of $4.85 in your example.
Okay.
So I'm following you. Now, keep in mind, you're really talking a cash bid, not a futures bid, right, for this purpose.
Right.
Because it's an actual cash bid to get it to the whatever point your delivery is. So.
Right.
But if you just have a futures contract out there, then you would. The thing to keep in mind is apples to apples. If I have a futures contract for $4.85. And now the futures contract is $5.25. It's a futures contract. Then I would mark that to there'd be profit or loss on that.
So what do you just use whatever that current day's bid? So
just
tomorrow, so today if I wake up and it's 45, and tomorrow I wake up and it's 4.90, and that's the day I put my wheat in the bin. It's 4.90.
Correct. Now again, so you don't want to be doing this every day, even every week. So you for sure you do this at 12/31, right? If you're giving something to the bank,
right?
Whether you do this on every quarter, even, right? Public companies do a quarterly thing, but should you do this at September 30th? Because it's kind of pointless at some point, right? Because that's what you talk to Chip about. Obviously every a few cents, now I'm gonna book profit because the grain market went up a few cents. That is true.
Yeah.
But you generally don't adjust this all the time. It's maybe after harvest, right?
Yeah.
When you've got everything in the bin, you don't bother with, trying to estimate the value of your growing crops. That's a whole other thing, right? What if we're doing our books as of August 31st here in Illinois and the crop's pretty much made at that point?
Yeah.
Do you go to the trouble of saying, well, here's the value, but I still got to harvest it? It's a lot of work for nothing, right? So typically you'd like to say, well, I'm just going to wait until I got all the grain in my bin to do this mark to market because it is unrealized, right? It's kind of like the stock market, right? If Caterpillar here in Peoria, is a big company. If Caterpillar stock goes up $5 a share, a lot of people around here, are making money, right? Because they own cat stock. But if they don't sell it, it's not really money in their pocket. So it's just kind of a compromise because the alternative is, you just use cost. And again, because grain is it's a commodity and you've got a ready market, accounting says, hey, you can use a market price. Very unusual that you can do this in accounting. Most of the times you have to have a customer. So I hope that makes sense. But you wouldn't do this every week or
oil, like stuff like oil and natural gas, stuff like that would all fall into the same realm?
It would, yeah. We don't have any clients in that realm, but it's really a commodity where there's an established market. And again, just kind of take off your and there's different rules, but it's similar. And so I think it would, you could have that be your method of accounting. And as long as you're kind of part of these financial statements, tell the lender, hey, here's how we're doing things, right? You'd have a note that would say, it would be very clear to the lender how you're doing it, how you're recording, your revenue and things, just to communicate how you're doing it. So this is generally viewed as the best way, just because it's not perfect, but it's a lot simpler because you don't have to even track your costs that well, right? What's my cost per bushel on corn versus beans? It really doesn't matter, right?
Right.
And it does matter when you're actually doing crop budgets, but at the end of the day, it's just, hey, just let the chips fall where they may and act like I sold all my grain that I have unpriced at the bid price. So it can kind of put a shock into you too, right? Hey, maybe I should sell it. If corn was $4 at December 31st and you didn't sell, you kind of kick yourself later. So it kind of forces you to say, hey, I could be selling this grain at the market price every day or every month. And so it's not a bad thought process to get through. Is, well, what if I was forced to sell all my grain at the bid price? Am I going to be profitable or not? And so that, it'll clearly tell you that. The financial statements would tell you that, obviously.
Right on. Okay.
So that's the biggest thing, the grain. Some of the other things, we talked about accrued rent, accrued interest. Again, just because you haven't paid your loan payment, there's still interest accruing every day, right? With John Deere Financial, whoever it might be. So you'd have to book those liabilities. Accrued real estate taxes, property taxes on your farmland, right? You would record an expense almost every month, right? Because it's not just when you make the payment. Here in Illinois, we make payments, twice a year. So you wouldn't put all your expense in the 2 months you make the payment, right? You want to gradually spread that out and things like that. So the other thing is one of the bigger things for lenders is they like to know what your working capital is or your current ratio. These are two different. They're kind of two of the same. Another flip side of the coin, you could say. Current ratio and working capital are talking about the same thing. It's just a little different take on the ratio. But one of the big things is knowing what the current maturities of your long-term debt are. So I know I have, $5 million of debt, let's say, but how much of that is due? How much principal is due in the next year? And so if it's due in the next year, I have to treat that as a current liability. And it's not a long-term liability because obviously, it's due in the next year. So I compare that to my cash on hand, my grain on hand, my prepaid expenses. Those are current assets, right? Cash, grain, because I'm likely to convert those to cash in the next year. So that's a big thing lenders like to see. It's not that hard to do, but you have to know your schedule of payments on all your debt, right? And then just say, here, what's due in the next year? And so that can really help you with crop budgets if you're starting to work on crop budgets for next year. For cash flow purposes, because we've talked a lot about today, Casey, for book income accrual basis purposes. But for cash flow purposes, right, you need to know, when are these loan payments coming due, what months even. But at least on your financials, all that they require is, hey, how much of these loan payments are due in the next year? And if you're going to have a problem on your hands, you can anticipate that and work with your lender, hopefully to get something moved. So that's a very common adjustment as well. So
okay, good deal. All right, well, lots of stuff to think about there as usual, Glenn. But if guys want to get more information about this and reach out to you, how would they do that?
Yeah, best thing, here at Heinold Banwards, we're in East Peoria, Illinois. Our phone number is 309-694-4251. I'd be happy to talk to anybody as you're, again, working on your crop budgets, whatever it might be. Definitely check out that Farm Financial Standards website. But then also look me up on Twitter at Glen Birnbaum.
Okay. What was that website one more time?
Farm Financial Standards Council. If you Google that, it's just a lot of good people get together on what's the best way to there's accounting standards that come out for the masses, right? And there's new ones coming out every year about how big companies, manufacturers, retailers should apply these standards. For farming, it's kind of unique. Agriculture producers, it's a unique take on it. So they have almost their own standards that they've published. And so definitely, if you're curious at all, if banks are asking about it, it's a good resource. Farm Financial Standards Council.
Right on. Okay, Glenn. All right, Glenn. Well, hey, have a good week and the rest of this week, I guess, and we'll talk to you next week. Thanks, buddy.
Okay, Casey. Thank you.
Thank you.